Hey folks, Jeff Bangerter here with Bangerter Financial Services. Today I really want to talk about on the DSTs, on the Delaware Statutory Trust, who can actually invest in these, because it is restricted in a way. It's restricted to accredited investors. And so I just wanted to really kind of dive into that a little bit for you and kind of help you understand why. So back in 1933, the Securities Act was enacted, and then in 1946, the U.S. Supreme Court case, there was a case, the SEC against W.J. Howey Company, and it was said that, hey, in order to purchase an equity interest in a DST investment, the investors must be an accredited investor. And I should really kind of restate that. It was really how this whole securities law came about, and then in when the DSTs became available, you have to be an accredited investor to be able to invest. And this is defined by the Securities Act because of that lawsuit. So an individual accredited investor is simply someone with a net worth excluding your personal residence, because they wouldn't want you, and we wouldn't want you, to have to sell your personal residence to be able to eat, right? So you have to have $1 million or more net worth, again, exclude your personal residence. And then alternatively, you can qualify if you have a income of $200,000 as an individual or $300,000 as a couple. And you have to have it for the last 2 years and reasonably expect to continue to make that income over the next year. So now you can do a 1031 into just another property without these qualifications, but in order to qualify for the investment into these securitized passive investments, the Delaware Statutory Trust solution, you need to be an accredited investor. And so as we look at that, I think that you'll start to understand why, right? They, again, don't want you to invest. We don't want you to invest if this is your only liquid money, right? So we want to make sure that you have other liquid assets, that you have assets in the bank or stocks, bonds, mutual funds, whatever it might be, that you can access those assets. So a DST and other real estate syndications are considered securities because they involve the selling of fractional interest in these managed accounts, right? So we have somebody else, the sponsor company, managing the investment, and you have a common interest in this investment with all of the other investors. So in 1946, a Supreme Court case, again, this Howey Company case, they had a large tract of citrus acreage in Lake County, Florida, and the company planted about 500 acres annually, and they kept selling that off and saying people could invest in that. Well, each prospective customer was offered both a land sales contract and a service contract, and again, they were promised these returns. And so this was stressed that, you're going to get this return, and then the reality came back and said, no, it's not a guarantee. It is actually a security, and it's controlled by the Securities Act of 1933. And so, this has been a broad definition ever since, that any of these real estate projects or anything else, oil and gas, partnerships, all these different things that have this promised return based on the performance of someone else, the sponsor company, are considered as securities. And based on those rules, these DST product offerings fall into that. And so we want to make sure that everybody's aware there are these time constraints, right? You have to be prepared to be invested for 3, 5, 7, or 10 years. We don't know, because the sponsor company is not going to sell the assets in a down market, and they're not going to liquidate a multi-million-dollar project because you need your investment back. So you have to be prepared to stay in the investment over the long haul. And when you kind of compare this with like a real estate investment trust or other strategies like that, this is quite a bit different, because in those investments, you don't really know what you're buying, right? You're getting into like a publicly traded REIT. Well, they're buying and selling real estate all the time, or a non-traded REIT is even more, you're not sure what you're going to be getting into. And so with these, specifically what property you're going to be invested in, but again, it is a fractional interest, and you're giving the control to the sponsor company. So it is a security, and you're investing with, hundreds or even a few thousand other investors into these offerings. Now, it falls under Rule 506 of Regulation D to be an exempt offering. So it's not a traditional security where we can offer it to everybody. So these Reg D offerings, these 506 Regulation D offering, are again just for accredited investors. We use a private placement memorandum. Sorry for all the jargon that goes on here. But anyway, the private placement memorandum gives you all of the indications, all the what's going on inside this. So when you actually read it, you'll be able to see this is a specific apartment complex or a specific medical building or a retail center or whatever it is. You'll actually have all the details so that you can make an intelligent, informed decision about it. And that's what we give you, and that's what we go over with you as an advisor for you, right? We don't have a vested interest in any of these sponsor companies. We don't have any vested interest into which one you might choose to use. So our goal is to help you understand each one and how each one will potentially benefit you, and of course the drawbacks. When we talk about accreditation, again, for the individuals, we've already talked about that, the $1 million net worth, excluding your home, or $200,000 income as an individual, $300,000 as a couple. But there are other ways that you can qualify. Like if you have a irrevocable trust, and the trust is the actual owner of the asset, or a corporation, or a partnership, then the accreditation is higher. It's $5 million. So we look at that. Now, if it's a pass-through entity like a trust or an LLC or a partnership, and each one of the people involved is an accredited investor, we can look through to each investor from that perspective too. So all of these things are part of what we take into consideration to determine whether or not we can do this. Now, I always like to point out a revocable living trust or a family trust, because that's not irrevocable. That qualifies as just as an individual, right? It's you and your spouse, you guys created the trust, so we're going to look through that and look to your individual net worth and make sure that you qualify as an accredited investor. And those other entities we talked about, the LLCs and partnerships and so forth, as long as each individual qualifies as an accredited investor, we can look at theirs, or we can look at the entity. It's kind of whichever one really best suits the situation for that. And all of these things are really designed to protect you, the investor. That's our goal as well, right? We want to make sure that you understand what you're doing, that you are in a position to be able to hold these assets for that, again, 3, 5, 7, or 10-year hold period until it's appropriate to sell. And you don't want us to sell if it's in a down market. You want to wait. So you want to have the sponsor company do really the right thing by you. So hopefully that makes sense. If you have any questions, give us a call, 800-451-2351. Locally, 916-965-1879. That's locally. That's California phone number. Of course, these days we all have free long distance, or it's all the same anyway. But I've had those same two phone numbers for over 30 years. They are not going to change. So again, toll free, 800-451-2351 or 916-965-1879. You can find out more about us on our website at bangerterfinancial.com, and certainly reach out to us anytime. Thanks so much for watching.